Gautam Trivedi, good morning. Thank you for joining us. Let's start with your market outlook. You are of the view that the recent lows of sub 16,000 will be tested again. I mean, a bull becoming a bear, you have a reputation of being a perma bull.
Yes, I do, unfortunately or fortunately. But the fact is, I think you've got to wake up to the ground reality of what's happening in the world around you. And Europe's already in recession, the UK is in a recession, and the US is headed in that direction. So I think every major stock market guru in the US who have infinitely more experience and maturity than I do are calling for one starting early next year. So I think the question really is, will India decouple or not decouple? And I don't think we can decouple, to be honest.
But this year we've decoupled and we've done rather well. Dow is down 25%, Indian markets are flat. So some would argue that what has happened in the last 3-4 months in terms of the outperformance, that just could get amplified.
Yeah, Nikunj, here's my point. Let's not look at local currency terms. Look at in the dollar terms, we're down actually 14%. The S&P 500 is down 23%, and the Dow is 24, Nasdaq's 30. So to that extent, it does appear that we've to some extent decoupled. Having said that, I think there are a lot of factors that are actually coming now to the fore. Number one, until the last 2.5 to 3 years, there was no real alternative to equities. I mean, let's get real. Right? Interest rates were nearly at a 20-year low. Real estate had been dead for the last at least 7 to 8 years. And as an alternative investment class, there was nothing but equities. The second thing that helped the equity penetration in the country was eKYC, the fact that you had 750 smartphones, 4G speeds. You could be sitting in a bus, you could be sitting on an island, and you could buy and sell stocks. And of course, the zero discount brokerages that emerged. So I think a lot of these factors helped in doubling or the number of demat accounts over the past 2 to 3 years. All very good. But when you start having a real and credible investment alternative to equities, which is starting to emerge finally, given the rapid rise in interest rates globally, and as a result of that in India, and of course, real estate's come back as a significant alternative, as not necessarily as an investment opportunity, but actually to buy. And ironically, the profits made in the equity markets are fueling that demand in the real estate space as well. So I think if you look at that going forward, I don't think India can decouple. And if you look at even, I guess, the S&P 500, which has corrected since 1990, it's corrected 10% or more 26 times. And it's taken the whole world down with it. So let's get real about the fact that, yes, things are going great for India right now on the domestic demand front, on the FDI front. All of that ticks all the boxes. But if a recession were to come in the United States, we will not be spared.
Okay. Gautam, just wondering how you're reading into the big news this morning, IDBI disinvestment, one step closer. And I'm guessing that, while of course there are a lot of questions and we all know that this is a long drawn process, that the government has been wanting to apply for a while now, and there have been very few successful candidates in that sense. But right messaging, I would think.
Yes, I think if they can pull this through and it doesn't hit any more hurdles or some of the bureaucratic delays, it would be fantastic. And I think the next major privatization after Air India. But honestly, to do one every couple of years is really not what the government needs to do. They need to do several of these. And whether it's Shipping Corporation, whether it's BPCL, or all the names that they had on that list, they don't seem to see. They haven't made the light of day as yet. So if IDBI goes through, great, but we have many more to go. And I think the government, hopefully after this IDBI sale, the privatization and divestment gathers momentum.
Gautam, hi there. Morning. The other big trigger that the markets will be watching out for is, of course, the earnings season. Today, it'll be kick-started with TCS, and by and large, as always, we'll be tracking the commentary a lot closer than the actual fine print in terms of the numbers. Walk us through what exactly it is you're working with in terms of earning expectations and how important the Q2 numbers in particular are going to be for IT.
Yeah, I think IT is really been a tough spot for a lot of people, including us. We own Infosys in our fund, and it actually has been not a very good performer, as you can imagine. We bought it right at the beginning of when the FI selling began and in the hope that the selling was over and the most liquid names, i.e. HDFC Bank or ICICI Bank, or for that matter, the IT companies, the selling would have stopped. But I think beyond the selling, the problem then emerged was the fact that with the US and Europe in recession, will the earnings sustain? And I think I don't want to get into what necessarily may be the numbers for this quarter, but the commentary coming forward from the big four IT companies is going to be very critical in deciding the fate of where these stocks go over the next 3 to 6 months, because there is a real problem in the US. I hope the US companies, which otherwise are cash rich, great balance sheets, do not cut down on IT spend. So I think we haven't seen any major warning signs as yet, but I think the commentary is really going to decide the fate of these stocks going forward.
Gautam, I'm wondering where in this earnings season will the positive surprise really come in from? Because, few things like commodity, inflation, etc., are starkly different this time than the previous quarter.
Yes, on a year-on-year basis, you're absolutely right. I think I'd like to see, for example, the steel companies and see their numbers. Of course, the steel companies have done a great job of the supernormal profits, wiping out a lot of their debt, which is great. But just to see a trajectory of some of the commodity stocks or where they're seeing going forward, how they're seeing earnings evolve for the next 2 to 3 quarters. I think that's going to be important. I want to also, focus on the auto sector, because we've seen a massive rebound coming back. And again, this was in the Economic Times that I read maybe a week ago, that passenger cars, as an example, are up 44% for the month of September over September 2019. So we're looking at absolutely comparing apples to apples pre-COVID. And that's a very positive signal. So I think some of that commentary also will be very useful. And I think the one other sector that I'd like to hear more on is the telecom sector, and see how ARPU is shaping up for this last quarter.
Well, if I look at your top holdings, they include the names like ICICI Bank, Infosys, Sequent Scientific, Bajaj Auto. I've read out the top 5 names, but I cannot see or spot a single cyclical or industrial name here. Isn't that the toast of the town? Buy cyclicals, buy industrials. You're not betting on it?
See, our investment philosophy actually is quite different, at the risk of sounding different. But it is slightly different from the regular mid-cap or multi-cap fund. And that is that we look for stocks that we believe have triggers. And the triggers could be any one of the following: a change in ownership, change in CEO, generational change, which again can be very important, because good companies can be murdered by bad children who can, I wouldn't use the word bad, but children who don't know how to run companies, or are not interested in running companies. And similarly, you have mediocre companies that can be taken to the next level, like what Sanjeev Bajaj has done with Bajaj Finance, and for that matter, what Siddharth Lal has done with Eicher Motors. So we look for these kind of triggers. We also look for things like M&A, restructuring, financial restructuring, deleveraging, de-pledging. And you mentioned Z. So the last category that we look for in terms of triggers is yesterday's large caps, today's mid caps. And we believe that Z potentially could regain some of its lost glory when it used to be a large cap.
That's a good way. Yesterday's large cap, today's mid cap, and today's mid cap will become large cap. So let's talk about yesterday's small cap, today's mid cap, and tomorrow's large cap. What falls in that category? That's an easier category, right? Why to bet on somebody which has become small could become big? Let's look at tiny becoming large.
Sure. In our first fund and in our second fund, and again, I don't want to market to these stocks, so we own these stocks. I'm going to give a disclaimer. But one of the companies that we really like is Hindustan Foods. I think you should have the promoter, Samir Kothari, over on your channel, because he is today one of the largest contract manufacturers for FMCG companies. And the name Hindustan Foods actually is a bit of a misnomer, because he's gone beyond foods. He makes shoes, he makes Harpic for Reckitt Benckiser, he makes Surf Excel and Wheel for Hindustan Lever, among other products. So I think that's the kind of stock that when we first invested, the market cap was sub 1,000 crores. It's now climbed to more than 5,000 crores. And this is a company that's going to keep growing by leaps and bounds as they add more capacity, bring on more clients, all MNC clients. So as a result, and more importantly, the fire in the belly that the owner of this company has, the promoter, Sumit Kothari, is fantastic. So that's an example of the stock that we do like. And
this company, if my memory serves me right, and I'm just discussing it here for the benefit of our viewers, higher volume, no margin business?
Higher volume, lower margin business, yes. But they have a take or pay relationship with most of their OEMs, and they have an 18% assured ROE. So it's effectively the Dixon Technologies of the FMCG business.
Way of looking at it, Dixon of the FMCG business. If you like Dixon so much, why not buy Dixon only? Dixon is Dixon.
It's too expensive. There are a lot of companies in India. Here's the thing, Nikunj, let me tell you, and you raise a fair point. The companies that we don't like are expensive. The companies that we like are very, very expensive. That's the problem today in India. And frankly, if a correction were to come through, it would be the best thing that can happen to the Indian stock market, because you'll bring in significantly more capital, both FII and domestic. So I think the reality is a correction would be actually welcome, and it would be very healthy for the next 3 to 5 years for the Indian equity markets, because you can't possibly be trading at more than double the multiple. We're 20.3 times CY 2023. MSCI China is at 9.3 times. MSCI emerging markets is at 11 times. So we are clearly very, very expensive. We have always been historically expensive, but this is now getting to the very, very expensive zone.
I don't know if I'm correct with this one, but is Varroc Engineering in your portfolio?
Yes, it is. It is.
So I'm wondering how you've read into the news of them selling their four-wheeler lighting business at a reduced price from the earlier 600 euro to now 520 million euro, and how the street has reacted to it.
Yeah, fair point. I mean, first of all, we can't possibly have all blockbuster stocks. We're not exactly Sachin Tendulkar in his prime. So, this stock has been a bit of a disappointment given what you just said. But we're trying to connect with the management and figure out why that's changed. So I don't have an answer yet.
When you do connect with them, let us also know, because we've also been trying as hard as you. But anyway.
Definitely.
Just looking at the market right now, cement, Gautam, that is where, especially after, Adani's buying Holcim's stake, now we're picking up buzz that they may be interested in JP Associates as well. That's where all the M&A seems to be heating up. And India Cements, no one can ignore that price action.
Yeah, I think, Aisha, cement has been a bit of a laggard like pharma for the last, few years. And given the infrastructure spend that's come through from the government, and they've really done a great job of building out more roads, more highways, and the pickup in real estate. So I think at some point that has to start reflecting in cement volumes, cement pricing, all of that. So I'm a little disappointed that the cement sector hasn't done anything. We don't own a cement stock. Talking of cyclicals, that's probably an area we would put money into, because it's a very local India business, and it's not really impacted by global cement prices, because there is no benchmark global cement price. So I think that's something we are actively looking at, just haven't gotten comfortable yet in terms of buying it. Yes, and what you said about Adani and JPA, and depending on who else is out there looking at bidding for JPA assets, there, I think going forward will be a lot of M&A activity. So it might end up falling into our trigger-based methodology, where we look at stocks that have a trigger, and M&A being one of them.
All right, Gautam, it's interesting to get in your strategy, your outlook as to how you're approaching companies, the portfolio selection, as well as outlook on the markets, where you believe that we perhaps will not be able to remain decoupled if the US goes into recession, which is a high likelihood. Good having you on board. A quick